Hey guys, Dave Silliman here, talking to you today about opportunity zones. You know, I love this program. It's one of the greatest tax and economic development programs in the entire history of our country. It's something that's never been done before, where basically every federal agency got involved with this program. They all created grants for this program. There's over 300 plus opportunity zone grants that exist at the federal level, but most people, when they think opportunity zones, they're thinking real estate. And what I love about this program is how to use opportunity zones for startup businesses. And opportunity zones for businesses are very unique in the sense that you actually, from a fund and program standpoint, you have double the amount of time to inject capital into the business, meaning that you have a way to utilize a opportunity zone fund to stabilize a business for a 5-year period of time, which is typically those first 5 years is when most businesses fail. So I love that for that fact. The second thing I love about opportunity zone funds for businesses is that this program has the ability to change the narrative of how venture capital traditionally works. And because it gives a lot more control back over to the CEO founder of the business. Now, every business, as you're growing, you need capital. And an opportunity zone fund can inject massive sums of capital into a business. And the fund is going to inject that into a qualified zone business. So your business has to meet the parameters within the safe harbor provisions to be an eligible investable business for the fund to invest into. But assuming that you've done that, a fund can inject massive amounts of capital. You're talking millions of dollars into a operating business. Now, when it does that, it's going to be purchasing equity in that business. So it's going to be taking an ownership position in that business. Now, up to this point, that follows your traditional venture capital model. Where we begin to deviate is when we look at time. Okay. One of the things that makes this program unique is the fact that the Opportunity Zone Fund investors, so let's say John, Jane Doe sold, Bitcoin, and they put capital gain money into an Opportunity Zone Fund. So John, Jane Doe investor, okay, right around that 10-year mark, when they get their personal benefits, that full step up in basis to fair market value at exit, they're going to be looking for and being itchy for, hey, how do I get out of the Opportunity Zone Fund? Now, remember, they purchased equity in that fund. So the easiest strategy to create exits is equity buyback, equity buyback. So the fund is more than likely going to buy back the fund equity from John, Jane Doe capital gain investor. Now, where is the fund going to get the money to be able to do that? Now, with businesses, this is why I love businesses as well. There's no ceiling on what profitability could look like for a business. See, when you think about real estate, every real estate deal in an opportunity zone, and really every real estate deal period, you're going to be capped. That's why you have cap rates. You're going to be capped at how many units you have, how much you can sell, rent, lease for, etc. You only have but so much square foot at $1 per square foot price. Okay. A business has no ceiling on earnings capability, which means that as a equity owner in that business, which is what the fund is, that equity owner would be entitled to distributions from that business's profit each year. So the fund can receive money in and then distribute money out. Now, all of this flows K1, K1. So the structuring is LLC, LLC. But when we think about exit and the 10-year time frame, this is where it gets, again, creative for the business, because the business can structure a buyback of that business equity from the fund, thus creating a very clean 10-year exit. Now, normally, when you exit with businesses, all right, you're looking at DCFs, typically with, a discount rate, a NPV value to it. You're looking at potentially a VC valuation, maybe a Harvard valuation model that gets ran. But the idea is you're trying to figure out when in that waterfall curve is a business going to be profitable enough with an X factor to earnings that we can then sell, right? And get our money back. Well, instead of having to look at what the business value is at time of sale, meaning what is the future value of the business in 10 years, when the business is seeking the funding today, it could structure agreements in place that would give it the options to buy back the equity with capped values or maybe at set rates. So that way the business doesn't necessarily have to buy back at full value. They would be able to buy back at a discounted value because it was preset today, and creating a clean exit for the investors. Now, the big thing for these investors that separates Opportunity Zone Fund investors versus your normal VC investors is that this program is all about the growth on capital gains being 100% tax-free. So they're going to want to have their money grow, but most Opportunity Zone Fund investors are not looking at this program as aggressively the way that normal VC investors are out there looking for aggressive rates of return. Because by the time that you add in the value of the step up, the value of the deferment to a taxpayer, and depending on when they invested, they may even have received 2 step ups on the deferment. All of that matters. So when a fund, says to an investor, "Hey, we think that we're going to have, an 8 or 9 or 10% rate," the reality is the rate of return to that investor is more like 20, 21, 22% return by the time you figure your tax benefits. So that's why Opportunity Zone Fund investors are looking at these things a little differently. Now, with that in mind, it gives the flexibility of the business owner today that ability to get the capital that they need very, very quickly, create the jobs, because that's what the part of this program is for. Remember, there's 4 pillars to the Opportunity Zone program. You got community revitalization and development. That's going to be your real estate, your ground up, your rehab, business, job creation, safe neighborhoods, and then workforce development. Now, your safe neighborhoods and your workforce development, those 2 pillars of this program are almost never talked about. The business side, which is slowly growing, it's right now the business side represents right around 15% of the ecosystem in general. A year ago, it only represented about 5% of the ecosystem. So we're seeing the business side and the business utilization of this program become more and more, which is why I think that when we look at this program long term, the biggest benefit of this program is not necessarily the real estate development, but the job creation from businesses and new businesses coming into the Opportunity Zone space. And the reason I say that is for twofold. Number one, you have exponentially more horizontal verticals for businesses to come in. You got manufacturing, you got technology, the list goes on and on and on, right? You can do farming. I mean, it's actually easier just to tell you what you can't do. And I'll do a separate video on the sin businesses for this Opportunity Zone program. But for the most part, if it's a business and you meet the parameters of how to qualify via the safe harbor provisions, then you're eligible for investment. But businesses, number one, create new jobs. Number two, those new jobs and better paying jobs, that's what stabilizes gentrification, which is a concern when you think economic development. And that's why this program incorporated the business piece. Because when we look at the CRA program, that's been around since the late 70s, the Community Reinvestment Act, which was amended for the first time in like 11 years to incorporate opportunity zones. But when you look at what that program did and some of the negative opinions on that program is that program caused some gentrification issues. Well, the way that you balance the rising cost of quality housing, all of that, and that's what gentrification is pushing people out of one, area because the cost of living gets to be too expensive and they can no longer afford to live in that area. So you stabilize that by expanding the job opportunities and how those job opportunities pay. And that's where the Opportunity Zone program comes in a massive, massive way. The other thing I love about the program is that, technically you could have a localized grouping of businesses and they could structure and set up an Opportunity Zone fund themselves to support the growth of those businesses. So, this is a program that as much as it's being taken advantage of by the 1%, it equally can be taken advantage of by the 99% at the local level. And that's something that's not really talked about